Sharp China panics over Trump's re-election. In November 2024, Donald Trump secured victory in the American presidential election. This result has sent shockwaves through the global economy, particularly the Chinese economy. During his campaign, Trump promised to impose a high tariff rate of 60% on Chinese products. This far exceeds the maximum of 25% from the previous administration, and could potentially deal a fatal blow to the Chinese economy. Currently, the Chinese economy faces multiple challenges, including a slump in the real estate market, high unemployment rates among young people, and increasing deflationary pressures. During the U.S.-China trade war in 2018, China managed to withstand tariffs of 25%. However, the situation is vastly different now. China's economic strength has significantly declined, and it's highly uncertain whether it can endure the unprecedented high tariff rate of 60%. Following Trump's victory, Chinese President Xi Jinping promptly sent a congratulatory message. This can be seen as an expression of China's sense of crisis. President Xi stated, "When China and the U.S. cooperate, both benefit. When they fight, both are hurt," demonstrating a willingness to improve relations. However, it's unlikely that Trump's hardline stance will easily soften, and the outlook for the Chinese economy appears extremely challenging. Trump's China policy extends beyond just raising tariffs. Policies are expected to cover a wide range of areas, including strengthening intellectual property protection, halting forced technology transfers, and restricting Chinese companies' investments in the U.S. If these policies are implemented, China's position as a manufacturing powerhouse will be significantly shaken. Moreover, Trump has indicated a tough stance on Chinese companies exporting to the U.S. via third countries like Mexico, which will severely constrain Chinese companies' export strategies to the U.S. Sharp current state and vulnerabilities of the Chinese economy. The Chinese economy has shifted from its former high growth period to serious stagnation. The main factor is the downturn in the real estate market. The real estate market, which was booming in 2018, has cooled rapidly since 2021. Many companies, including the major real estate developer Evergrande Group, have defaulted, and the entire industry faces a crisis. The real estate market slump has directly hit local government finances. Chinese local governments heavily rely on income from land use, rights sales, and the cooling real estate market has deprived them of their main source of income. As a result, many local governments are facing severe financial difficulties. According to International Monetary Fund (IMF) estimates, China's total government sector debt is expected to reach about $20.7 trillion, approximately 3,000 trillion yen by the end of 2023. Furthermore, data from the Bank for International Settlements (BIS) shows that when household and corporate debt are included, the total amounts to about 350 trillion yuan, approximately 77,000 trillion yen, which is about 3 times the size of the economy. This enormous debt is weighing down the Chinese economy. In addition to the debt problem, the Chinese economy is also facing serious employment issues. The unemployment rate among young people, in particular, exceeds 50%, becoming a factor for social unrest. The job shortage for university graduates is severe, with many young people unable to find stable employment. This situation is also leading to a slump in consumption. Chinese household spending remains at 40% of GDP, which is 20% lower than the global average. Due to low wages and uncertainty about the future, many Chinese are restraining their consumption. This is making it difficult for the Chinese government to transition to the domestic, demand-driven economy it aims for. Furthermore, deflationary pressures are intensifying. In September 2024, the Producer Price Index fell 2.8% year-on-year, and the Consumer Price Inflation rate dropped to 0.4%. This indicates that the Chinese economy is falling into serious deflation. Deflation can create a vicious cycle by squeezing corporate profits and leading to decreased investment and employment. Sharp Trump administration's China policy and expected impact. During his campaign, Trump demonstrated a tough stance towards China. Central to this is the introduction of a high tariff rate of 60%. This far exceeds the maximum of 25% from the previous administration. He has also suggested the possibility of imposing a 100% tariff on electric vehicles (EVs). If such high tariffs are implemented, the impact on the Chinese economy will be enormous. According to estimates by Daiwa Institute of Research, the introduction of 60% tariffs could potentially lower China's real growth rate by up to 1.3 percentage points. This would be a fatal blow to the already struggling Chinese economy. The impact will be particularly significant on China's major export industries. Industries such as electrical equipment, machinery, furniture, and clothing are expected to be hit hard by the decrease in exports to the U.S. These industries account for a large portion of employment in China, and their impact could lead to a further deterioration of the employment situation. Trump has also shown a tough stance on Chinese companies exporting to the U.S. via third countries like Mexico. He has expressed his intention to impose a 100% tariff on such circumvention strategies, where Chinese companies build factories in Mexico and export from there to the U.S. This will significantly constrain Chinese companies' export strategies to the U.S. Furthermore, Trump has shown a tough stance on issues such as intellectual property protection and forced technology transfers. If these policies are implemented, China's position as a manufacturing powerhouse could be significantly shaken. The impact on high-tech industries is particularly concerning. The Made in China 2025 plan promoted by the Chinese government will face major obstacles. On the other hand, Trump's policies could also affect the U.S. economy. The introduction of high tariffs could be a factor in pushing up consumer prices in the U.S. Retaliatory measures from China are also expected, and trade friction between the U.S. and China could further intensify. Particularly noteworthy is the impact on global supply chains. Many U.S. companies have production bases in China, and the introduction of high tariffs will significantly affect the management of these companies. Some companies may be forced to relocate their production bases. This could lead to increased costs for U.S. companies in the short term. Moreover, Trump's policies could lead to a stronger dollar. If the dollar strengthens along with high interest rate policies, it could potentially decrease U.S. export competitiveness. This could lead to results contrary to Trump's goal of reviving manufacturing. Sharp China's countermeasures and impact on the global economy. How will China respond to the Trump administration's tough China policy? The first thing that comes to mind is the devaluation of the yuan. However, according to analysts at Capital Economics, to fully offset a 60% tariff, the yuan would need to fall 18% against the dollar, a level not seen since the Asian currency crisis in the 1990s. A significant devaluation of the yuan would be a double-edged sword for China. While it would lead to improved export competitiveness, it would also increase the risk of capital outflow. It could also cause import inflation, potentially further cooling consumption that is already sluggish. Furthermore, it could invite criticism from the international community as a currency manipulator. The next consideration is the implementation of large-scale economic stimulus measures. However, for China, which already has enormous debt, large-scale fiscal expansion is difficult, especially with the current situation where local government debt problems are worsening. The traditional investment-led growth strategy has reached its limits. Therefore, the Chinese government may accelerate structural reforms. Specifically, this could include reforms of state-owned enterprises, modernization of the financial system, and strengthening of innovation promotion policies. They may also promote policies to balance domestic demand, expansion and exports based on the dual circulation strategy. However, these reforms take time, and a slowdown in economic growth is unavoidable in the short term. The slowdown of the Chinese economy will also have a significant impact on the global economy as a whole. China is the largest trading partner for many countries, and a decrease in its demand could lead to a global economic recession. The impact will be particularly significant for countries with strong economic ties to China, such as Australia and Southeast Asian countries. These countries will be forced to develop new export markets and diversify their industrial structures. As uncertainty in the global economy increases, other countries, including Japan, will face difficult choices. Rather than siding with either the U.S. or China, they will be required to develop balanced diplomatic and economic policies. It will also be important to build autonomous economic development strategies, such as strengthening their own industrial competitiveness and fostering new growth areas. What do you think about the Trump administration's response to China? Please share your opinions and thoughts in the comments section. Thank you for watching until the end. I look forward to meeting you again.